Can you guys
So,
hear me?
yeah, Scrap, what's going on?
Oh, not too much. I was just going to say, I overall see the market going down much more, and I don't know if it's reasonable thinking or not, but my thinking is that there was never a chance to raise the interest rate sufficiently after the first stimulus from the 2001 and the 2008. And when they tried, there was a lot of market pushback. So they pivoted. And I'm thinking this time they really need to compensate for the stimulus from 2020, but also from all the extra stimulus from the 2008 great crash that they never had a chance to roll back. And I think if they don't, maybe there's a good possibility that we could end up with even crazier inflation rates like happened in the 70s when they didn't tighten enough and they pivoted too soon.
Well, that's the problem here, and I agree with you completely. With let's go ahead and put the SPY on here. Let me put on, let's see, SPX. I need SPX. We got to go farther back in time. This was before the SPY's time. Yeah, here we go. The 1970s twin crashes, and these were both high watermarks of inflation. So we had here, here. Let me go ahead and just remove all that. There we go.
And an
So
energy crisis at the time, right? Or upcoming.
there was an energy crisis at the time, in the 70s, and a housing. There was a housing crisis also. It was caused by the interest rates that were directly correlated with inflation. All of it translated into a period of stagflation. And you could see that, like, even the whole stock market just went nowhere for this entire decade, right? It was just it was a time where the market just it couldn't get anywhere, right? It just couldn't get anywhere. And as a matter of fact, it doesn't look all that different from the dot-com bubble if you think about it. Because look at how similar these two areas of the chart are. We had this peak here, and then a crash, and then another peak that was slightly higher, and then it crashed even lower. Looks quite similar, doesn't it? But the problem is that this was much lower inflation. It was high. It was considered high at the time because the Fed wants it to be 2.5% or lower at the most. It prefers to have it at 2%. Below 2% is the ideal range for the Fed. They want a little bit of inflation, but never more than 2.5%. Ideally, they want it at 2%. And they never really got too excessive when inflation went this high, but this whole situation was much different. See, before, lower income was not able to finance for their homes, and of course that put massive pressure on the banks. But for the most part, people that were financially secure and weren't going out doing crazy things like buying 4 or 5 homes, they didn't really have as much risk, and they were able to hold on to what they had. Even though it was not good for anybody, this translated into us being able to tolerate the level of inflation, and it went away rather quickly because of the subprime crash. Actually, the massive drop in the subprime crash put so many people out onto the streets, actually caused a huge period of a huge amount of deflation very quickly. We actually were deflating our currency, because there were so few people. There was so little consumer spending at the time. Consumer spending was so low at the time that we saw restaurants like giving away food and giving away product just to get people in the door on the chance that they would buy something, because they were losing money shipping in product that no one was buying, and the product was just going to waste. So they, in desperation, when you see things like restaurants and stuff just giving away free food, that's when you know things are truly bad, and that's when we saw deflation. The only other times that we saw deflation that was this bad was after the Fed aggressively. Oh no, this was actually like after World War II, and after the panic of the 1920s. So anyhow, what am I going? Where am I going with all this? we have a combined assault against the economy with inflation and an energy crisis and a conflict going on with Russia and China, which a lot of the same things that was going on in the 70s. The biggest difference now is that we had a tech sector boom that is now coming crashing down, and that's not something that we had in the 70s. Tech sector didn't exist then. And the only time that we had something similar to look at was the dot-com crash, which we all are very well aware that the dot-com crash was devastating to the economy. It was devastating to the West Coast and the West Coast housing market. We don't know what it's going to look like this time. The only thing that we do really know is that we're having inflation that is on par with the 70s peak inflation. We haven't quite hit these levels yet. If the Fed pivots anytime soon, then we should absolutely expect a massive surge of inflation if the Fed decides to pivot too quickly. Thanks for pulling up the definition for this, Tipped. So Tip pulled up the term of a deflationary spiral. Deflationary spiral. That's what I was pointing out down here. These areas of massive deflation. This is called the deflationary spiral. And where did you pull this from, Tip? Just so that I can credit the source.
I found that on Wikipedia.
Wikipedia. Thank you. So while hyperdeflation is rare, deflation by itself can lead to pernicious negative feedback loops. A deflationary spiral is a downward price reaction to an economic crisis, leading to lower production, lower wages, decreased demand, and still lower prices. These events often occur during a period of severe economic crisis, such as the Great Depression. Deflation occurs when general price levels decline, as opposed to inflation, which is when price levels are generally rising. When deflation occurs, central banks and monetary authorities can enact expansionary monetary policies to spur demand and economic growth. If monetary policy efforts fail, however, due to greater than anticipated weakness in the economy, or because target interest rates are already zero or close to zero, a deflationary spiral may occur, even with an expansionary monetary policy in place. Such a spiral amounts to a vicious cycle where a chain of events reinforces an initial problem. So that sounds like a whole lot of no fun. And I recall from watching history on the Great Depression of the amount of joblessness and the amount of crisis that was going on in America at that time. Back then, the money was so tight for people that there were lines around the block for soup kitchens. Everything was reliant on donations for people to continue living. And you saw such rampant homelessness that people had set up these massive shanty towns. Literally, they called them Hoovervilles. This was especially characteristic of Queens, the neighborhood in New York City. And Queens, New York was so overrun by all of these homeless people that had set up these shacks in the neighborhood because they had nowhere else to go, and there was no food, no energy, no sanitation, and it was just a mess. And this was actually the battleground between a lot of workers' labor unions and police who were paid off by business owners that were running all the factories and stuff, where they just, they would pull up in cars and trucks, and men would line up to go and take a job, and they just pick people out of the crowd. Like, we need 6 guys, you, and then that's it. No more. Everybody go home. And there's just a crowd of 200 people that are desperate for work so that they can afford food for their families. And I would like to hope that we can prevent something like that happening, but we don't know. This situation is getting really out of hand to the point where
We
it's
had
like
a little bit
we have to
we had a
act.
little bit of a taste of that in 2008 with tent cities and people lining up outside of temp agencies fighting for few jobs, and employers being so selective that you were overqualified, underqualified. We had a little bit of a taste of that from '08 to '10, I remember.
Yeah.
Yeah, it'll be a lot worse.
Scary. I hope not, but scary.
Well, look at the factors we have. I mean, we're way more in debt, right? With more than twice the amount of debt we had at the time. We
Yeah.
have a conflict with China and Russia. We have oil shortage, which we can't like it's relatively inelastic right now. We can't increase our energy supply over the next several years that quickly. So I see it getting a lot worse. There's less weapons to fight and more issues.
Yeah, and the over leveraging of debt and the amount that's in the shadow banking system, as I've been reading about it, I'm worried what happens when they get to that tipping point and they all want to rush out of the banking system. Isn't that going to put some issues on the credit markets in the country?
What's about to happen? That's why you see credit swaps going up. Of
Yeah,
course,
and we don't even know what is behind all that because
it's like.
it's not
Sorry,
declared, unfortunately.
I'm sorry, Scrap. I didn't mean to interrupt you. Go ahead.
Oh, not a problem. Go ahead, Phil.
I was just saying, I think there's 25 quadrillion dollars in credit swaps now, if I'm correct. Something like that. I mean,
Jeez.
I don't even know a number that big.
that's what I'm saying. I mean, it's like, where did this come from? This is the most dangerous thing that was changed, that allowing of all these derivatives.
Yeah, I've come to believe that most of those derivatives are evil and they certainly need to be regulated. They're a big source of the problem and they cause perversion in the market.
Well, the
Absolutely.
whole problem with it is that the leverage is so strong that if it only takes a few firms that are unwilling to take the loss and cut it early enough and just admit that things are that they've lost, that we get into these spiral situations. Because some of these firms are so big that when they fail, it causes massive ripples throughout the entire economy. Because when they fail on their obligations, when they go into default, then they cause a whole bunch of assets that are basically promised to other institutions that those institutions are relying on for their profit. And it screws up
Ponzi scheme.
everybody. It's like this massive domino effect that when one firm fails and all the assets they were holding on to become worthless, then 20 other banks suddenly realize, oh shit, our balance sheet just got totally destroyed because we've had 10% of our assets and our growth oriented assets were tied to this one firm. And it turns out that they were totally full of it and they were taking on losses that they never reported. And that's exactly what Lehman's did. When Lehman's went bust,
Yep.
they actually caused systemic failure for other firms like Morgan Stanley and Goldman Sachs and all the other big banks on Wall Street, the Bank of Milan, New York Bank of Milan, all of those major firms had huge losses just suddenly added onto their balance sheet just because a few banks over-leveraged themselves and cooked the books to hide it. And that's where the problem is with this leverage. The regulation is one thing, but not being able to enforce the oversight from a few bad actors is what really, really drives these massive losses. But I agree with you that the derivatives themselves are so dangerous that they shouldn't really exist. The derivatives themselves shouldn't exist because the leverage is too dangerous.
For one reason.